How does the Plan 3 system work here in Washington State? So in this video, we're going to talk specifically about Plan 3 as it applies to people on the TRS, CERS, and PERS retirement system. So if you're a teacher, school employee, or a public employee on Plan 3, this video is for you. So Plan 3 basically includes two parts: your defined benefit, otherwise known as your pension, which is a guaranteed payment for the rest of your life, and you have your defined contribution plan. This is the side that you personally invest your own funds into. It operates much like a 401k, although the rules are slightly different for this particular plan. So this video, we're going to break down both components of it, and we're going to answer questions like, when can I collect my pension? When am I vested? What can I do to increase it? We're going to talk about a little known feature called indexing. We're going to talk about penalties for collecting your benefit early, the different investment options you currently have, how that plan is taxed, how you can contribute from it, and when you can get access to it. So you can see we've got a ton to cover in this video, so let's dive right into it. First, let's start off with the defined benefit, otherwise known as your pension. So as I mentioned earlier, this is a guaranteed paycheck for the rest of your life, as long as you're vested into it. When it comes to vesting, it's either 10 years for working, or it's 5 years, so it's one of those years coming after age 44. So once you're vested, you're entitled to that future benefit. Now, how do you calculate that benefit? The formula is pretty simple. 1% for every year worked here in Washington State, and you're going to multiply that by the average of your top 5 years of income. It's your top 5 years, not your last 5 years. So they're going to look over the course of your career, pick the top 5, average those out, and that's what they're going to base your benefit off of. They also include things like national boards, coaching, or any other income you get from a state-covered employer. So all of that income is going to apply to your top 5 years. So what this means, let's say you're an admin for about 5 years, and then you go back to your classroom towards the end of your career, you're not going to get dinged because you make less at the end of your career. So let's give you an example. If you worked 30 years here in Washington State, 30 years times 1%, that's 30%. Now let's say you average $100,000, keep the math easy. 30% of $100,000 is $30,000 per year for the rest of your life. Now that gets paid out monthly, so you can expect to earn $2,500 per month for the rest of your life. Now, what can you do to increase that benefit? Well, there's only two parts of the form you can control, and that is you either gotta work longer or make more. And if you're at the end of your career and you're in those top 5 years, taking on an extra job or a side project and get a little bit extra income can go a long way in increasing your pension payouts. Now, one other thing to keep in mind is that your plan comes with something called a cost of living adjustment, oftentimes referred to as a COLA. So in order to be eligible, you have to first retire, collect your pension for a full year, and then the July 1st after that is when you're eligible for the cost of living adjustment. Now, the cost of living adjustment can be between 0 and 3%. Now, one thing to keep in mind here, if you're ever in a high inflation period like we currently are, you get only 3%, even though inflation's at 6% this year, you don't still get only 3%. However, that extra 3% goes into a bank. So in a future period, if inflation's less and they're only going to give you 1% COLA, they're actually going to reach into your bank and push you up to that 3%. So it's called COLA banking. I got a whole video on it, and I'll link that up here. So now the question is, when can I collect my benefit? When you can collect depends on when you're hired and how long you've worked. If you're hired before May 1st of 2013, then you're going to fall into one pot. The next thing you want to look at is if you have 30 years or not. So if you're hired pre-May of 2013 and you have 30 years of service credits, then you're going to be eligible to collect your pension in full with no penalty at age 62. If you're hired after May 1st and you have your 30 years of service, it's age 65. There's no early collection for people hired after May 1st of 2013. Anyone that has less than 30 years is age 65 regardless. Now that's for your full benefits, no penalties. You do have the option, however, to collect your benefit early and take a penalty if you want to. Now, if you have 30 years of service, you can actually collect it before your full age, and you'll still take a penalty, but it's a lot less than if you didn't. So anyone that has 30 years of service hired before May of 2013 can get their benefit as early as age 55 if they want to, and it's a 20% reduction. If you wanted to collect it just 1 year early at age 61, it's only a 2% reduction. So they take away 2% for the first year, and then it's 3% for every year before that up to 55. So the max they'll take is 20%. Now, if you have 30 years of service, but you're hired after May of 2013, your benefit starts at 65, and collecting it early results in a 5% penalty per year. You can collect it as early as 55, but it's going to be a much larger deduction because you have a 5% reduction all starting from 65. Now, the minimum number of years you need to work to even consider taking the pension early is 20 years of service. If you don't have 20 years of service, collecting your pension early for a penalty is not even an option. So if you have 20 years, you're eligible to collect your pension early. However, because you have that 30, the state's going to penalize you, and they're going to have much steeper than if you were to have those 30 years. And they have a chart broken down by every single month. And if you look at the chart, you probably get lost in it. Basically, it starts off at about 8% and it keeps getting worse the earlier you retire. Someone asked me once, what if I collect at 50 55 without having my 30 years service in, and it was like a 30% payout. So they lose like 7% of their benefit. Definitely something you want to avoid if at all possible. Now, one little known benefit that exists in Plan 3 is something called indexing. So if you said, hey, I wanted to retire age 60, but hold off collecting until 62, that's completely fine. There's no penalty to apply. So if the indexing comes in, they're going to give you a guaranteed 3% raise in your pension payout. So if you said, hey, I'm done working at 60, I'm going to go do something else, and your pension payout was supposed to be, say, $30,000 that time, you're going to get a 3% raise for those 2 years. So your $30,000 is going to go up to $30,900, and then it will go up a little over $31,000. Indexing only exists in Plan 3. It's a really unique feature. All right, so that pretty much covers the pension. Benefits coming completely from the state. All of your money goes towards the defined contribution plan. I really like to refer to it as the Plan 3 bucket. Some people call it their 401k. So what this is, it's a retirement savings account. So you're allowed to contribute anywhere from 5 to 15% into this account every single year that you work. Keep in mind though that under the current rules, percentage you elect stays locked in until you change employer. Then you have a 90-day window to make a change again. So it is a decision that shouldn't be taken lightly. And you want to make sure if you're going to put in a lot that you can see yourself affording to do so for a long period of time. So once you have that percentage, your money gets invested every single month that you contribute into it. The funds come off your paycheck on a pre-tax basis. And what that pre-tax contribution does is generate a tax deduction for you. So if you currently make $50,000 and you're putting in 10% or $5,000 per year, that $5,000 is going to get deducted from your income for tax purposes. So rather than filing taxes on $50,000, you're going to pay taxes on $45,000. What you're doing here is deferring paying the tax on that money. So remember that $5,000 is going to go in. It's going to earn interest for 10, 20, 40 years. And then whatever it's worth at that time, you're going to have to pay ordinary income taxes on it at whatever amount that is, at whatever future rates are. So just something to keep in mind when you're doing these pre-tax investing. Now, when can you access these funds? You only have access to these Plan 3 retirement accounts at retirement or separation of service. So as long as you're employed, no matter how old you are, you cannot touch this money at all. As soon as you separate service, this money is free and clear to use how you want to. Of course, you still have to pay taxes on it. And if you're trying to pull this money out before age 55, there's going to be another 10% penalty on top of that. The amount of taxes you pay will depend entirely on what taxes are in the future at the time you collect and how you collect it. So if you collect in small portions, you may not pay as much tax. If you take the entire benefit at once, that counts as a taxable event. So it looks like you made $100, $200, or $500,000, whatever your account balance was, to the IRS, and it counts as income. Definitely shoots you up in the tax bracket. So you want to be careful when you decide to distribute funds to yourself that you don't take out too much and forget about taxes on it. All right, so now Plan 3 actually does have investments inside it. And this is where a lot of people kind of overlook things and they get kind of scared if they don't know what to choose. So most people when they started got defaulted into the WSIB fund, otherwise known as the TAP fund, which is ran by the Washington State Investment Board. It's one of the more aggressive funds out there. Now that changed in 2011, and since then everyone hired after that is getting placed into a target date fund. Now a target date fund is basically a portfolio of stocks and bonds, and as you get closer to it, they're supposed to make it less risky. However, many studies have shown that that's often not the case. It leaves young people taking not enough risk in their earlier years, which can sacrifice some of their growth, and people getting close to retirement still have too much risk than what they may realize in their portfolios. So be careful when using the WSIB or the target date funds. They may not align with your risk tolerance. And the good news is you have the choice to make a change at any time you want to. So you can choose any other investment that exists in the plan. The bad news, there's not a lot of options. There's only about 7 individual funds that you can pick and choose from, but it's still better than sitting in one of those target funds because at least you can customize how much risk you're willing to take. They have basically a cash fund that pays 1% or less. That's fairly safe. You've got bonds, socially responsible, which is kind of a blend, large cap, global, international, emerging market, and then a small cap in there as well. So those are all the funds you kind of pick and choose from. Now a lot of people get confused because they're like, I don't want to invest my own money because I don't want to mess things up. I don't want the market to crash and lose my funds. And I hear you. What I did here is actually went ahead and just pre-built portfolios that you guys can model for your Plan 3 account. So whether you're 1 year away from retirement or 4 years away from retirement, there's a model right for you to pick and choose stocks and bond combinations for you. And anytime you can go in and adjust the portfolio that you want. So that service is available now, and it's been a really big hit with a lot of my clients. So if you want access to it, the link is in the description below for you to go in and check that out. One more quick thing to know is that Plan 3 is not the only retirement plan that you get access to. Your employer also has other supplemental retirement plans. Now often those are in the forms of a 403b plan or a deferred compensation plan. So those are some other options you may want to check into if you're wanting to save more or save someplace other than the Plan 3 fund. So if you're interested in learning more about those, I'll have those linked over here for you guys to check out. I'll see you guys next week. Remember that your future depends on what you do today.